What's up, YouTube? Jeff Coga here, and kind of my daily vlog I decided to do as I'm driving into the office, and I'm going to talk about some stuff that's on my mind. I've been up since 4:45 this morning, and I want to talk about something called divergent thinking and convergent thinking, and how this relates to the current stock market and the plays I'm making, so that way, one, I can do the complete opposite of what everyone else is doing, and hopefully I can turn my bet into $500,000 in the next how many months or a year or a couple of years. Okay, so first off, what is the thinking pattern that most people have, right? And it boils down to a saying you hear me say a lot, which is what? A tomato, knowledge is what? Knowing that a tomato is a fruit. Wisdom is knowing not to put it in a fruit salad, right? And if you didn't know, some other weird, quirky things about what some people think are vegetables versus a fruit are things like avocado, things like bell pepper, right? These are technically defined as a fruit, but we look at it as vegetables, right? It's the strangest things, okay? But the world that we operate in, if you start studying kind of the philosophers and understanding how the mind works, right, you'll start understanding that there's two trains of thoughts typically when we think, and that is divergent thinking and convergent thinking. Okay, now convergent thinking is what we're trained and taught. If you're a millennial or a Gen X or a baby boomer, or if you're a millennial and your parents and you're like, well, my parents don't blah 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 blah, it's because the environment and education system that we are part of is taught to be a convergent thinker, meaning, hey, we have to regurgitate answers based on memory, right? Like understanding that, hey, 1 + 1 = 2, but not really understanding the addition component of it, right? Or just memorizing, hey, what's the capital of X, Y, and Z, right? Like those are really convergent thinking type of stuff, versus divergent thinking is creative thinking. Right? In terms of asking questions to have a deeper understanding of a problem. All right. Now, how does that relate to what's going on? Okay, so stock market or the equities market, all right? I'm a real estate guy, but when the real estate market crashed back in 2008, okay, I started investing in real estate in 2004. I started swing trading, all right? And if you don't know what swing trading / day trading means, which is you're actively trading stocks in a 1-day period or in a week period, typically, okay? Or maybe it can be a month, right? And you're trading, and then you're trying to make money off trades, right? Versus the old typical way of thinking, where if you work at a 9 to 5 or your employer, or what majority of the individuals know is like, hey, let me go ahead and put some money in a 401k, and then my employer is going to match it or match a percentage of it, and I'm just going to let it sit, okay? And that's the idea that people have, okay? Now, what I've been saying on kind of like my Facebook live stream and my Instagram, and even I was ranting about Periscope last year, is I was talking about how if you have a 401k or some type of qualified retirement plan, okay, 403b, you know, or whatever it is, right? Solo IRA, or whatever retirement account you have, I told individuals to take some of that money that you have and get into cash position. Right? Cash position. So that way, if the market has a little bit of a correction or a hiccup, you have the ability to, guess what, be able to buy the stock back at a discount, right? So some of the people listen, right? Like, for example, my brother, he went kind of extreme, and he sold off all of his stocks, his equities that he had in his 401k with his company, and he went into cash position. All right, now, why did he do that? Okay, I don't recommend this for most of them, but he did that because he contributes a lot of money every single month into his 401k. So his thought process and idea, if I had to guess, is it was just like, you know what, hey, I'm gonna lock in my profits here. At least I have this in cash, and every single month I'm putting money away, a couple $1,000s a month. So hey, you know what? If the market does go up, at least I'm gonna catch some of the uptrend, right? That's kind of the thought process and philosophy. So he has caught some of the uptrend of this year, 2017, and but I want you to start thinking about, again, going back to divergent thinking and convergent thinking, is that where are we? right? We've been in a bull market. And if you don't know what bull market means, it just means the market's going up, okay? And we've been in an up market. End of this year, it'll be about 9 years, depending on where you say the bottom is, okay? Now, based on that, if you start looking at historical data on where we're currently at, and I'm talking about this is as in United States, okay? Even though literally across the globe, we're seeing an upswing in the equities market, is you got to start asking, okay, if the average is 8 years, we're going to be 9 years. We're already 1 year over, okay? How long is this market going to keep on going up, right? That's the question you have to ask. And so to answer that, you have to look at data, right? Don't get caught up into looking at the news or watching what everyone else is doing, because, you know, one of the things I've learned at an early age is from a book it's called Lead the Fields, okay? Highly recommend for anyone that's a bookworm, want to expand your mind, want to learn, right? Read this book called Lead the Fields. It's by Earl Nightingale. It's a super, super old classical book. It's like one of those books where, you know, like Napoleon Hill's Think and Grow Rich, right? It's a classic book that you should read. And one of the key lines in there that I picked away at an early age is they say, if you don't know what to do, just know that the majority is always wrong. So they imply that you should do the complete opposite of what the majority is doing. All right. So what is going on currently right now? Well, it's hard to say. You know, as a real estate standpoint, same thing. We've been in a bull market and prices have hit 2007 levels in some areas. Okay, not all areas. Okay, but certain areas. So people are saying, you know what? Are we at the peak of the market? How many months do we have? And for real estate, I believe maybe we got about 18, 24 months to go. All right. Why is because even if we hit 2007 level prices on our real estate homes, right, we're not adjusting for inflation. So if inflation is truly based on a CPI index, consumer price index, right, or the CPI index, I'm sorry, at 2%, 3%, but let's just take for easy math, it's 3%, then if it's in a 10-year period, then you know, even if we hit the 2007 level based on simple interest without compounding interest, the number that we should have, it should be 30% more. So for example, for the easy sake of math, I'm going to use $1 million. So if it's at $1 million and in 2007, I'm in California, so I'm using $1 million. If you're not, just take out a zero. Then that $1 million to hit the all-time high has to turn into $1.3 million, right? 30%. Now, if you're having challenges doing that math in your head really quickly, it's because majority of time when we learn math, it's because we learned math by what? Convergent thinking, just memorizing. So we don't know how to apply it when we actually start adding extra zeros in it. Okay, like people are like, oh my gosh, extra zeros, and they freak out and they can't do basic math, right? Like basic multiplication. So if that's the case, if it's at $1 million in 2007 and we're here in 2017, 10 years later, and it's $1 million, we still have about $300,000 to go as an upside, right? Follow me? Okay, so now, coming back to the stock market, all right? I made a bold move this morning. I ranted about this on Instagram yesterday as I was driving home because I got into a trade. All right, this trade is literally something called leveraged ETFs. So when the real estate market crashed after, 2007, 2008, and, I was like literally like, oh my gosh, how am I going to make money? I started swing trading, right? As I said earlier, and I made money by trading stocks. And in this case, I was trading in the equities market. Sorry, not in the equities, a commodities market. Okay. And not only that, but the commodities market with an ETF that's leveraged. All right. So if you don't know what that means, just literally means that, instead of doing things on margin, right? And if you don't know what margin means, it means that you're using basically borrowed money or credit cards to buy stocks, okay? And that's how it's done. And instead of that, it's already priced in there, okay? It's priced into the stock. So typically you get 2 to 1 on your money, 3 to 1. Okay, and it's based on an underlying stock that's on there, right? So like I would use leveraged ETFs, that's it for natural gas, oil, gold, right? Silver, that kind of stuff, right? Miners, and I would do things like that, and I would trade, and I would make good money off of it. And on top of that, I would use margin too, so it's like the upside was even bigger. All right, so I know a little bit about it. So earlier this year, actually, matter of fact, October 1st of this year, I started actively buying stocks. All right, prior to that, I just been on the sideline watching, but I was just like, you know what? let me rebuild this muscle again that I had, because it's been so long, right? Almost 10 years, a decade since I was swing trading. So I reached out to some of my friends that were actively trading, some of the people I met, some of the people, you know, they canceled on me or whatever it is, right? So just trying to get my groove back. And I was just like, you know what, let me go in. So I went in and started making some simple trades, right? Especially going into kind of the big companies, right? And started buying them. And the idea I had at that time was to simply hold on to and do it kind of like the Benjamin Graham style, right? Hold on to these stocks, dividend paying stocks, and then just buy, right? And then I was gonna call it a day. Now, the reason why I decided to do that is because it's a retirement account, right? It's a retirement account. Okay, so meaning that it is deferred. And the reason why I had to put money in there is because instead of paying Uncle Sam, I put money in there so that way I can get the deduction, right? As a small business owner. So I have money in there, and I was just like, okay, I can't touch this retirement account money until I'm 59 and a half, right? I can take loans on it, I can do X, Y, and Z and that kind of stuff. So I'm just like, I was doing these simple trades, and some of the trades like EXPI, that's one. It's a real estate company, right? You know, EXP Realty, I got into that trade, got out, made some 15% return on my money on that. Other ones I've got in was BTSC, BTCS, which is a derivative of like kind of Bitcoin stuff, right? Not really Bitcoin, but I got out of that. Some other ones were Shopify. I did some other trades on even Pandora. Did some trades on Facebook, and stuff like that, Apple, right? Like basic ones, right? I have like Heinz, right? I had even Miracle Grow, right? So I got into this, and I was in about almost like 40 trades, okay? 40 positions I was in, right? And I'm watching, and then I was just like, you know what? This is not my style. Right? Like, it's not my style, because the way I made money in the past is I didn't put my eggs in multiple baskets just so I can quote unquote diversify, right? Because diversification is something that financial advisors teaches, right? Why? Is because it's easy for the common man or woman to understand, and it's a way for them to get into the game. Right? So I did diversification when I was 18, and I would buy mutual funds, index funds, and stuff like that, and I would diversify, and I made money off of that as well, right? So, but as you start learning other sophisticated investing style, put calls, that kind of stuff, right? Leverage ETF, inverse ETFs, right? That kind of stuff, then you start learning other ways to make money and for much higher returns. Same thing in real estate, right? Most people understand in real estate is to buy and hold on to it, right? And rent it out. Other ways, if you're a little bit more sophisticated, they'll talk about flipping, right? Flipping houses, right? Buying it, fixing it up, and then selling it. Now, if you're a little bit more sophisticated above that, then they'll start talking about something called wholesaling, right? Which is like literally options in the stock market, which is you make an offer to buy a property and get it under contract at a strike price, and then you find a buyer that's willing to pay slightly more than what you have it under contract for, and that difference is literally your money. So, for example, if you get a property under contract for, again, $1 million, and it's really, after it's fixed up, it's worth $2 million, right? Now, why is it worth $2 million? Is because it's an old 1910 house, and you have to knock the whole thing down and build a brand new house, right? So if you have to do that, it might be worth $2 million, $2.5 million, or something like that. Someone else might be willing to pay $50,000 over $1 million. So if you do wholesaling, you can do that and make $50,000, right? So, and I've done tons of these, okay? And then from there, if you're a little bit more sophisticated, you'll start learning about subject to and stuff like that, right? Keeping the underlying loan, equity purchase agreements, right? Things like that. And, you know, so again, there's so many ways to make money, right? Like, there's a million ways to make $1 million. It depends on what your tangible and intangible assets are. So as I started to look at this, I'm just like, dude, that's not my style. I have to go back to the fundamentals of what I know, which is, don't put my eggs in multiple baskets. Put my egg in one basket and make sure that it is the right basket, right? So as I started exiting out some of the trades, I'm still in some trades, right? Some trades are actually negative. Okay, I'm not saying I'm perfect, right? No trader is perfect, right? I found two huge opportunities on leveraged ETFs. One is natural gas, right? DGAZ, right? So you get 2-to-1 on your money on that. And I saw that, and I'm just like, damn, this is underpriced. And I believe big money is going to come back in there, and it's going to pop it back up, and I'll get at least 2 to 1 on my money in the next 30, 60, 90 days, or maybe even 6 months. Okay, so I put some money in there, right? Like very small percentage, right? I only put like, I'll give you the kind of numbers. I only put like 7 grand in that, right? Which is very like 3% of my portfolio of doing that, right? And rest I'm in kind of cash position and stuff like that, right? With these dinky little stocks too. And then I also found another position of which is a 3-to-1 pro shares leverage ETF, and I saw it where I'm just like, man, should I bet on this? So I put a little bit. Okay, like 1,100, and it was at 16, and I've been watching it since it was like $15, right? And it was $16. Now, in the last 12 months, the high was $400. Okay, and then since then it has gone down to 15, 10 or something like that, right? So I got in at 16 something. Okay, and I put only like $1,200 in it, right? So this yesterday, and that's the order was filled yesterday, so it's popped back up. And if you watch it, you can see like the VIX index, right? You can see how volatile it's starting to get. And as I'm watching this, I'm just like, man, should I just go all in on this? And that's the question I was asking myself. So I did a little rant on Instagram about that. And then as I woke up this morning at 4:45, I was just like, you know what? Let's do this. So I wasn't going to put more money, but I put in this case a little bit more. I may buy on the dips, okay? Probably, I'm not say may, I probably will. So I put in 10 grand on that, and literally my exit on that is I want to get 50 to 1 on it. Right, 50 to 1, meaning that it's going to go up to 500. And will that happen the next 6 months? I don't know, but I think it can happen in the next 4 years, because remember, the boom is averages what, 8 years. There's 2 that has happened where it went longer than that, right? Since the 1970s. Okay. Now, why am I using after 1970s? Is because that's when the dollar deleveraged from the gold standard officially from Richard Dick Nixon. So when they did that, so that's what I'm using. So one is like 12.7 years, I think, and the other one's like 13.2 or something like that. So let's just call it, 12 and a half years. So if it's we're at 9, we still got 9, right? 10, 11, 12. So we got 3 years. So in the 3 years, can I get 50 to 1 on my money? Meaning I can turn that 10 grand into $500,000. Right? So that's the kind of bet that I'm making right now. And literally I placed that order after I went to the gym, the market opened, I was watching it pop back up, and I'm seeing that. I'm just like, fuck it, let me do it. And so I took that position. And the reason why is because even in that other boom, right, there was 2 corrections that happened where it went down 10%. So if it went down 10%, volatility will go up, but then ultimately the big crash happened, right? So again, now I'm going super long on that. I'm going to hold on to it, and I'm going to see what happens, okay? But I believe that is the right basket, okay? So on the dips, I'm going to buy more. So why am I telling you this again? As I started this video, I said divergent thinking or convergent thinking, right? Do not be that person that's a convergent thinker. Be a divergent thinker, and then start questioning things, okay? Like, for example, if you watch this video and you've gotten this far, this is like 18 minutes in, and you got some value, leave me a question below, because a divergent thinker will ask questions, right? And or do their own research and due diligence and be like, oh, okay, well, how does the VIX index work, right? And things like that, right? And then you'll start finding out that it's based on put and calls options on the S&P 500, right? That's the underlining thing that they look at, and there's absolutely none, right? I'm sorry, I don't want to say none, but it has slowed down significantly. So then the question is, why? Right? And the reason has to be because of these leverage ETFs that are inverse, meaning people no longer have to do put in calls to actually hedge against a possible loss. They can simply use a leverage ETFs. So one of the things, as I was looking at it, I was just like, damn, man, is that the reason why they're not doing that? Why volatility is so low and everyone's talking about volatility, right? And then I'm just like, dude, can this thing really drop down to $3 a share or something like that, right? The VIX index, right? And I'm just like, I don't know, man. And that's why I was hesitant to come in, because if it does drop to 3 and I'm in at $16, $17, 18, that means literally you lose like 99% of your money, right? On paper, okay? But then the question at that time is, when it goes down, do you have the willpower, and are you not attached to the outcome, and then can you hold on to it? Because remember, you only realize a loss when you, guess what? You sell. You only realize a profit when you actually what? Sell as well. Okay? So that's kind of the bet, and I have a feeling it's going to decline, the powers that be, because look, if you search any of this stuff that I'm talking about, leverage ETF, like even DGA, ZU, UVXY or whatever, right? You're going to find all kinds of stuff. People talk about it's manipulated, it's trash, it's garbage, blah, 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 blah. Whatever it is, that's what you're going to find on the internet, okay? But then start asking yourself, okay, when you see that, what is the big money going to do, right? Listening to white noise on the internet at these forums or things like that, right? It can be really dangerous versus, hey, being a thinker and making your own opinions, all right? And that's why you want to be a divergent thinker versus a convergent thinker, right? Don't be a tool. Think outside the box. And then when you think outside the box, build your own box. And as I said earlier, wisdom is knowing knowledge is knowing tomato is a fruit. Wisdom is knowing not to put it in a fruit basket. So take the knowledge, if you've gotten this far, right, that you've gained, the new knowledge that there's other opportunities of investments that you can make money on, and then try to reach out to do more, you know, meet people in real life, shake their hands, people that are doing it, and then from there, turn that knowledge into wisdom and try to capitalize on this opportunity. That's what I got. Jeff Coga, I'm going back into the office. Love y'all. Take care. Bye-bye.